Hi friends, this is part 4 of a series of video lectures on GST. This video will deal about transition of credit, input tax credit which is being held in your stock as well as the capital goods.
Transition under GST. While transiting from the old tax regime to the new one, there are two important questions. How do you carry forward the input tax credit on your old stock and the capital goods? There are 5 cases which have been clearly laid down by the government. Let's quickly look through them one by one. Case 1. You are a taxpayer under central excise or VAT. Under the GST, you are a normal taxpayer. Now we will look at how do I deal with the input tax credit on stock. So your closing balance of your tax credit in your June 30 statement will become your input tax credit under the GST. Remember, cess balance cannot be carried forward. How do you do that? Simply fill GST Trans 1 Table 5. Conditions: you should have filed all your returns from January to June 2017. However, remember, you may revise your returns. Case 2. Let's assume you're an existing taxpayer under central excise or VAT, and under GST you are a normal taxpayer. Concern has arisen on how do I carry forward the unavailed credit of capital goods. All the unavailed amount of duty paid on capital goods can be carried forward. So under the existing central excise law, only 50% of the input tax credit on capital goods can be deducted in the first year. The rest 50% gets carried forward to the next year. So will it work in the GST? Yes, it will. You need not worry. You should have to just fill the table 6 of GST Tran 1, and the conditions are the same. You should have filed your returns from January to June 2017. However, you may also revise your return. Remember, self-assessment and no verification. That means whatever details you submit in GST Tran 1 will be taken as the value per se. Unless there is too much of variation, only then there will be a verification by the income tax department. We look at case number 3, 4 and 5 simultaneously. You could either be an unregistered taxpayer under the previous regime or a composition taxpayer, or you must be dealing with exempt goods under the existing law. Now we look at how will you deal with stock and capital goods in this scenario. Let me tell you, if you belong to either of the 3 cases, you will deal with stock in the same manner. You will be able to carry forward the eligible duties in respect of both inputs, your semi-processed goods and also the finished goods. How? Merely declare stock of duty paid goods in GST Tran 1 Table 7. Conditions apply. What are those conditions? Your input or goods are used for making taxable supply. You have your invoice or a document showing payment of duty, and if you do not have the invoice, you should have a credit transfer document which is issued not prior to 30th June. Now, what is this credit transfer document? Suppose you do not have any duty paying documents, you might request for a credit transfer document from your manufacturer. Remember, this scheme is available only for the traders and definitely not for imported goods. A credit transfer document can be issued for value above 50,000 and it has to be issued within 45 days. What if you do not have a credit transfer document from your manufacturer? The law has come out with a system of deemed credit. What does deemed credit mean? If you are now paying GST less than 18% on your goods and services, 40% of the payable tax will be claimed as deemed credit. If you are paying tax more than or equal to 18% under the current GST regime, 60% of it can be claimed to be deemed credit. How do you fill this? You have to merely declare stock of goods in GST Tran 2. So remember, if you do not have duty paying documents, if you are not able to avail credit transfer document, you can directly go to GST Tran 2 and fill this declaration on stock of your goods. However, this credit will be available only on sale. This scheme is available only for 6 months and only to the traders. The document of procurement of these goods should be available. In case 3, 4 and 5, we have seen what happens to stock. Now we will see what happens to input services. So if you're an unregistered dealer and now a normal taxpayer, you do not get any credit on input services. If you're under a composition taxpayer under VAT and a normal taxpayer now, you do not get any credit for input tax services. If you were manufacturing exempt goods under the existing law and now you're taxable, you can avail that credit for the input services. Now, in all the three cases, we have to check what happens to the credit on capital goods. So remember, for case number 3 and 4, where you will not be able to carry forward the credit for capital goods. But case number 5, where you've been dealing with exempt goods under the tax existing law and now you're taxable, you will be able to carry forward your credit available for the capital goods. Now coming to a very important question. What happens to the income tax credit of VAT and central sales tax? The input tax credit of VAT will directly be reflected in your last return. It will just be carried forward to the state's GST. Whereas your input tax credit of CST will not be carried forward, but rather it will be refunded. Please note this down. ITC of VAT will be carried forward to state GST, whereas ITC of CST will be refunded to you. So anything that you filled in your CFHI forms of CST will be refunded. If there is a refund or appeal pending under the existing law, what happens? Does it lapse? No, you need not worry. If it is not sorted out under the existing law, a judgment or a settlement will be made under the new law. Cash-driven provision has also been made under the new law.
Transition has been an area of confusion in today's market. Right now, the government has given September 30 as the guideline to submit your Trans Rule 1 and 2. If you're a businessman, I hope you found this video is helpful, and if you're not, please do share this video with all businessmen around. Thank you.